Have you ever signed a contract without fully understanding who would be responsible if something went wrong? If so, you're not alone. One of the most important and often misunderstood concepts in risk management is something called contractual risk transfer, CRT. Today we're going to break down exactly what contractual risk transfer is, why it matters, how businesses use it every day to reduce liability and protect their financial future. By the end of this webinar, you'll understand. Let's get started. How liability is transferred through contracts. What key contract provisions to look for. How to avoid common mistakes that could expose your business to significant financial risk. What is contractual risk transfer? Contractual risk transfer is the process of transferring responsibility for certain risks from one party to another through a written contract. In simple terms, one party agrees to assume responsibility for certain liabilities, damages, losses, or claims that might arise during a business relationship. Rather than each party retaining all of its own risk, contractual language reallocates responsibility. This creates clarity, helps avoid disputes, and often determines who pays when a claim arises. Contractual risk transfer is commonly used in construction projects, property management agreements, vendor contracts, service agreements, commercial leases, transportation contracts, professional services agreements. In many industries, effective risk transfer is considered a best practice. Why contractual risk transfer matters? Every business faces risk. Someone could get injured. Property could be damaged. A third party could file a lawsuit. Without a clear contractual framework, determining who is responsible can become expensive and complicated. Reduce liability exposure. Protect assets. Control insurance costs. Clarify responsibilities. Prevent legal disputes. Improve risk management. Think of it this way, risk doesn't disappear, it gets allocated. The goal is to place responsibility with the party best positioned to control or insure against that risk. The four core components of contractual risk transfer. Let's examine the four primary tools used in contractual risk transfer. 1. Indemnification clauses. Often the foundation of risk transfer agreements, require one party to compensate another for certain losses. Example, subcontractor indemnifies general contractor. An indemnification clause compensates a party for losses, damages, claims, or liabilities, can oblige a party to defend and reimburse the other, significantly impacts financial responsibility during a claim. 2. Hold harmless agreements. Closely related to indemnification. One party agrees not to hold another party responsible for specified risks, protects the receiving party from liability for particular activities. These clauses are common in construction, event management, property management, service contracts. 3. Additional insured status. One of the most powerful risk transfer tools, allows one party to be added to another party's insurance policy. Example, property owner on contractor's policy. If a claim arises, owner's protection may extend under the contractor's policy, provides significant defense and indemnity benefits. 4. Insurance requirements. Contracts often specify insurance requirements. Examples, general liability, workers' compensation, auto, umbrella, professional liability. Ensures financial resources are available when claims occur. Real-world example, a commercial property owner hires a roofing contractor to replace a roof. The contract includes indemnification language, hold harmless provisions, additional insured status, minimum insurance limits. During the project, because proper risk transfer was in place, a contractor's employee injures a visitor. The contractor's insurance responds first. The property owner receives additional insured protection. Liability allocation is already established. Without these provisions, the property owner could face substantial legal costs. Liability uncertainty. Common contractual risk transfer mistakes. Many businesses believe they are protected simply because a contract exists. Unfortunately, that's not always true. Mistake number 1, using generic contracts. Boilerplate contracts fail to address specific risks. Every agreement must be tailored to exposure involved. Mistake number 2, not reviewing insurance coverage. A contract may require protection, but the policy must support requirements. Never assume coverage exists, verify it. Mistake number 3, failing to obtain certificates of insurance. Whenever required, businesses should request and review certificates and endorsements. Mistake number 4, ignoring state laws. Some states limit or restrict certain indemnification provisions. Legal review is necessary. Mistake number 5, not updating agreements. Contracts should be reviewed regularly as business needs and regulations evolve. Best practices for businesses. To strengthen your contractual risk transfer program, review all contracts carefully. Work with qualified legal counsel. Coordinate with your insurance broker. Verify insurance requirements. Obtain additional insured endorsements. Maintain documentation. The most successful businesses treat risk transfer as an ongoing process, not a one-time event. Conclusion: contractual risk transfer is one of the most effective tools for managing business risk. By using indemnification, hold harmless, additional insured, and insurance requirements, businesses can protect themselves from unexpected claims and financial losses. Remember, the best time to address liability is before a loss occurs, not after. A well-structured contract can mean the difference between a manageable claim and a costly legal battle. If you found this webinar helpful, subscribe for more content on business insurance, risk management, and protecting your business assets. Thank you for watching, and we'll see you in the next webinar.